Hi, my name is Mark Miller and I'm the insurance producer here at Legacy Accounting and Financial Services. And today, as part of a talk on defensive retirement strategies, I'd like to talk about what are you doing to hedge against higher tax rates in the future. Now, there seems to be this intensifying drumbeat in certain political circles and election cycles that the reason that one person or group of people has very little to show for their working lives is because someone else did fairly well. While these pundits seem to ignore the fact these two groups made entirely different decisions along the way to arriving at their current financial statement, they are very certain of the solution. Tax the rich! Now, rich is of course a moving target depending on the policy, but it often starts with anyone making about $10,000 to $20,000 a year more than you do, for now. So vote for me and you'll be safe. That's right. Believe it or not, there are those who, in exchange for nothing more than your simple vote, promise to level the podium and give you all the free stuff, new government programs, and relief packages you need just as fast as that ink can dry on freshly minted money. Now, while you and I know free simply means somebody else is paying for it, and government funded means taxpayers, perhaps a farmer in Iowa, if you're not careful, and even if you are, that someone else will in fact be you. Now, between historically low interest rates over the past 15 or so years that we've become accustomed to, and various tax provisions that will either sunset soon, or depending on the balance of power back east and in some states, be upended by political agendas and overpromised, underfunded government programs du jour, means that for most of us, there's a pretty good chance tax rates are only going to go up moving forward. So, what are you going to do to protect yourself against that? Sadly, for all too many people, whether they realize it or not, the answer is actually nothing. Because all our lives we've been conditioned to take the write-off this year and defer as much tax as possible to some later date, perhaps when we aren't earning a paycheck, creating this illusion where we'll be in a lower tax bracket. The problem is, if you're good at delayed gratification and live below your means during your working years, making maximum contributions to your 401ks and IRAs and the like, there's a good chance you will have acquired enough funds over that time that at that ripe old age of 72, when Congress via the IRS demands you start liquidating your retirement funds, whether you need that money or not, the required minimum distribution could be the same or possibly exceed your current salary. What's more, you'll likely have fewer deductions to offset it, perhaps placing you in a higher tax bracket in retirement than you had while working, provided you're not still in fact working then. Now, of course, regardless of your tax bracket, what about the rates across the board going up to cover all that tantalizing free stuff that bought those precious votes? Oh, and that may also mean making more of your Social Security income taxable too, all at whatever rate the Congress and the IRS tell you it'll be then. Now, I'm not suggesting an all or nothing approach. Far from it. But any complete plan needs balance. Even if you build an asset that affords the ripoff, why pay more than necessary to the tax assessor's office when you don't actually have to? Who defines that all-elusive and nebulous term, fair share? After all, it's your money they're talking about. Shouldn't you be the one to decide who gets to spend it and how? What am I getting at here? Well, let's say you're a farmer and you're given the choice between paying taxes on your seeds or on your harvest. Now, given we expect our crops to grow over time so we may reap more than we sow, that answer should be pretty self-explanatory. Your finances aren't any different. Yes, there are some advantages to deferring some income and subsequent tax to a later date, as there are other perks to plans that can prove useful, but there is also an argument to getting the piper paid now. Buy out a portion of that contract sooner than later, so when he comes a-calling for the people who didn't heed the message, you can tell him to pound sand. What am I talking about here? It's not flashy, sexy, or even widely covered today, but it is one of the only ways to legally protect your hard-earned assets from the taxman while still having a magnifying effect. It's also important to understand there are rules here too, and that it's not a good fit for everyone, and in some cases may not be possible. Although it's not considered an investment or savings product, there are ways to participate in and lock in gains when certain markets do well while simultaneously protecting you from losing your shorts when the markets fail. In fact, with some limited exceptions, the worst you're going to do is a zero interest credit. This is why it's important to have a candid conversation with a trusted, knowledgeable professional who can walk you through the process and explain a few things along the way. I'm talking about permanent, cash value, life insurance. Why? Because it's a vehicle that when set up and funded correctly can not only be self-completing, in time it can pay for itself in perpetuity. The gains can also be accessed in such a way either once in a while or for years on end without ever triggering a taxable event, provided the policy stays in force. So even if you can take higher risks for higher returns with other vehicles, there's still that tax hurdle you need to clear on the back end. That's not here. It's also a vehicle that should something happen to you in your life that would require long-term medical care or maybe even an urgent need to live out that bucket list earlier than expected, the funds may be there to cover those expenses, also potentially tax-free. And when it comes time for you to sail west for that last time, your designated beneficiaries will receive the death benefit entirely tax-free, even if that benefit far exceeds premiums you ever paid. That simply doesn't happen with an IRA or even that coffee can you stuffed with C notes and buried in the backyard. Even if your motivations are more self-serving and not entirely rooted in those who will follow you, if at all, or if other family members or loved ones are not in your current picture, there are still some considerations to ponder as to why a good life insurance policy may still add value while you are here. It's important to note there are several types of plans, depending on your needs, and even then, not all similar plans work or perform the same way. Talking to an independent agent with access to multiple carriers can go a long way in finding the right product with the right carrier on the right budget. So to have an honest conversation and set up a no-cost, no-obligation appointment and to see what you qualify for, please give our office a call at 360-597-0400 or email us at office@legacyaccountingfinancial.com and we'll be happy to get back to you as soon as possible. Thanks, and make it a great day.